right? In double entry system, first we analyze the transaction. What do we mean by the analysis? That debit or credit rules. And now let's journalize it, which means we make an entry. So what is journal? Let's explore this. So a journal is chronological record of transaction, which means date-wise, step by step, right? So which means specify each account affected by the transaction, determine if each account is increase or decrease, right? So we do not write it down positive and negative here. We write it down increase or decrease, which means whether debit or credit side. We need to see that. And then we make a journal entry. So we also call this, in short, we call this journal, but some books, they also call this journal entry. So whenever transaction happens, we analyze it through these steps and we make an entry, journal entry, right? Journal, J-O-U-R, not general, G-E-N-E-R, G-E-N-E-R, journal, okay? This is journal. Now let's talk about the journal entry. So the rules, let me first explain the rules again, one more time, so that we are on. Here we go. So whenever we are making journal entry, we will start from debit and then we write credit. For example, if this is a column here, right? So first, if these are two lines, so first we write it down the name of the account which is debited. So these are the rules. And then we make a tab, a space here. So you see a diagonal space here, right? And then on the diagonal side, we write it down credit. So credit always comes second, right? So how we write it down? From debit to credit. So there's a diagonal, a tab line here, right? A space here, 6 spaces. So that we automatically understand that, because these are some tradition, there is no logic behind that. These are tradition, world convention. That is, if somebody else from Japan, Korea, Russia, America, they read the journal entry, they automatically understand that first we write it down the journal, in journal, the debit side, and then we write it down the credit side. And how we pronounce it? First we pronounce the debit, and then we say the word to, and then we pronounce credit. So let's talk about how to make journal entry. Right now, we are journalizing it and then we're posting it. So do not get confused with the word post here. Right now, what we are doing, we are journalizing the transaction, which means we are making a journal entry. So here we go. Back to our previous transaction in which we talk about the Fred is receive cash. Fred Auto Service as a company receive 50,000 cash and issue stocks. So what did we talk about that? In making journal entry, transaction analysis, 3-step, which two accounts, at least which two accounts are going to hit. So business receive cash, it means cash account is going to hit. So this transaction gonna hit cash account and common stock. Let me write common stock. So we successfully identified 2 accounts in which these transactions going to be recorded or journalized. So now, second step, whether cash is increase or decrease, cash increase. Common stock increase or decrease, the owner's equity, the owner's claim on the business increase or decrease, increase. So it means both cash and common stock increase. Now let's make a journal entry here. So first we write it down. So cash asset increase, common stock also increase. So when common stock increase, credit. When cash increase, debit. So first we write it down, the word here, cash. See, we write it down on the debit side, 50,000. And then we write it down the credit side, which is common stock or capital here. Right? And then we write it down a short explanation of issued common stock. So it's up to you. You can write it down, issued common stock against cash. You can write it down a short note here so that whenever you revisit this transaction or somebody else see that, they automatically understand, and okay, this transaction is like. So you see here, there is no more, it's like the shortest version of explaining all these transactions. Now how we pronounce it, we pronounce this cash to common stock. So whatever comes after the word to, it means that is credited. So we pronounce journal entry as cash to common stock. Cash to common stock. Again, cash to common stock, which means whatever comes before the to, this must be debited. So you see a debit side here, 50,000. And there is a space here as well. See? So we did not write it down cash and then on the same indentation we do not write down the word common stock. There is a space here, a little bit right side, right? Similarly, you also see that there's a diagonal. You can see the space here. So we write it down in column side, so it looks like this. Otherwise, it should be how we write it down: cash to common stock. We write it down 50,000 here. 50. So you see there is a diagonal space here. So this is how we pronounce it. Cash to common stock, right? So if I pronounce cash to common stock, so you automatically assume that after comes the to the common stock, it means common stock is going to be credited. And before the to, there is a cash, mean cash is debited. Let's move forward. So these are the T accounts, how we are going to record it. So there is an individual account and there is you can say, okay, we will talk about this in posting. First we focus on the word journal. Okay, so let's copy this information to posting. We call this ledger. Okay, let's explain this. So every T account is basically, in real life, these are registers or books. There is a left hand side of the page and there is a right hand side of the page. So in accounting, these books are called ledgers. Books or ledgers. So it means there's a cash book and inside all the transactions related to cash will be written. There is accounts payable book, we call this ledger, and everything we recorded in this accounts payable. How we represent it in accounting? In a T account format, right? So when transaction happen, the first step is journalize the entry, and then second, record that entry into the books of accounts or in ledgers or in T account. So transferring the transaction to the T account is called posting. It's called posting. So if we want to post it, so we make a T account here. In real life, these T accounts are books, registers, right? So let me clear the mess here. So our entry was on 1st April, cash to common stock. So you see, cash account is debited with 50,000. So it means we will write 50,000 on the debit side of the cash, and common stock is credited. So we will be writing down 50,000 on the credit side of the common stock. Here we go. See? So everybody understand? So let me ask one by one. Ella, Harry, Kim, Dayon, Marilyn, Na, and Pinyu. You understand what do we mean by posting?
Yes, sir.
Ella.
Yes.
Good. If you have any questions, all of you, please do ask. Okay. So first of all, what we did while analyzing the transaction, we segregate it into accounts and then we journalize it. When we journalize it, we convert it into debit and credit, right? So how we make the entry? First, we write it down the debit side. And then we write it down the credit side. And how we pronounce cash to common stock. And when we transfer from journal to this T account or ledger, we call this posting. So we post it into their respective T accounts or ledgers according to their nature, debit. Okay, so cash is debited, so we write it down on the debit side. Common stock is credited, so we write it down on the credit side. So this is not a difficult science here, not a rocket science here, it's just fairly common sense. So there is a flow here, what we talked about. When transaction occur, we analyze it. When we analyze it, we talked about which account is gonna hit by this transaction, and then we find out the accounts, then we see increase or decrease, and then we make transaction in journal entry. And after journal entry, we post it to the T accounts or ledger accounts. So let's talk about the transaction here, right? And we are going to analyze it with respect to accounting equation and journal entry. When we journal entry the transaction, we are also going to post it. So then you will realize that the accounting equation is a little bit different than the double entry system. So, but the logic is the same, right? So let's just talk about it. Received cash 50,000, issued common stock. We already did that. So how we are going to write it down? Since cash is increased, so you see here, equation is balanced, right? And if we convert it into double entry system, first we need to write journal entry. So cash increase mean debit, and common stock also increase, common stock increase mean credit. So first we write it down the debit, which is cash 50,000, and to credit the common stock, right? And then we post it. How we post it? We have a cash, we make a cash account here, cash T account. Here we go. So cash is debited.